feet. So that's how you.
So unit 2 is 3.5, and over and above that 1 lakh square feet. So about 4.5.
Unit 3 is 3.5.
3.5 will be in June 25. Okay. So, and also just a reiteration. So you were targeting 50% CAGR growth, I believe you mentioned. So two-part question. One, for how long do you anticipate to grow at this 40 to 50% growth rate? And is FY25 also 50%, or FY25 could be more than that? I think you said 100%. No.
We are in the fag end of FY25, right?
Right.
Q3 is almost over actually. So it will be around 45% the previous year. That's the guidance which you have given earlier, and we stand with it actually.
Okay.
And next year we are expecting 100% growth, but pessimistic, we should still continue to grow at 45 to 50% CAGR.
And no, but for how long would this be? Sorry, just one last thing. Let's assume you don't grow at 100%, grow at 50% in FY26 as well, which is not a bad number. How long do you expect to grow at 45 to 50%?
So instead of giving a number of years, I would rather try. I would try to put it in a different way. We have participation of along with the DRDO in almost several, all the indigenous missile programs. We have participation. 60% of the technologies which are part of these weapon programs, we have a participation. So many of these programs are actually entering into production phase in next few months, in next few years down the line. Apart from that, our own, fully, OEM rockets, and guided, unguided, we are developing, which will also take it. So this 50% growth will continue to be there for next 3 years. We will be growing like this consistently. Next year, if we are clocking 100%, kind of a doubling the revenues, then I can say, still will continue to grow from there. Another 45 to 50% will continue to grow.
Got it. Well, we wish you all the best for that. Lovely talking to you, sir, and thank you so much for taking the time out. All the best.
Thank you, Neeraj. Happy New Year to all of you and all the financial fraternity.
Thank you to you and yours as well. Much appreciate. Okay, a charged up conversation with Apollo Micro and JSW Energy's charged up as a stock, around 6 or 7% gains as we speak. This is because, or 5% gain. This is as the company signed a definitive agreement to acquire O2 Power. This acquisition is said to be the largest acquisition since inception. We spoke to the joint MD and CEO Sharad Mahindra about the benefits from the synergy and the benefits of the synergy of this acquisition. Here out a slice of that conversation.
See, yes, this is a very significant milestone in our journey of growth journey, and this is a very, very high quality asset. We have evaluated this asset on various parameters. Two of the benchmarks which are must for us for any opportunity which keeps coming in the market, the two tick boxes, the benchmark returns of mid to high teen IRRs, and also the build versus buy. So on these two parameters, this has been a very, very attractive value accretive acquisition we have found. Because if we see in terms of if we have to build this entire asset at maybe the total portfolio size is 4.7 gigawatt, and with almost 63% solar and 27% wind, so 37% wind. When we evaluate solar, if I have to build, we all know a very reasonably aggressive evaluation of 4.25 crores per megawatt, a build cost, and wind, we all know the industry 8 to 8.5 crores per megawatt, and we multiply with the capacities. We have found this to be very, very highly value accretive, and a solar dominated portfolio with a blended tariff of 3.37 rupees per unit is a very, very attractive asset. And also apart from this, few things which value, this is a very high quality, nicely built quality assets when our teams did the due diligence in last few months. And as we all know that countries, the kind of energy transition which is happening and the capacity additions which are happening, skill set is also going to play a very, very important right skill set availability. So the highly skilled manpower, workforce of O2 is what we are also getting, and now they are a part of JSW family, which will also help us in our growth journey of JSW Energy going forward, apart from the completion of 4.7 gigawatt. And just to give you an overview of this portfolio, 4.7, by June 25, 2.3 gigawatt of this portfolio will be fully operational. Part is already operational. So this will also help us in our capacity addition plan also.
The acquisition also takes the company's locked-in generation capacity to around 25 gigawatts. How do you now see capacity addition taking place? Could we see the annual capacity increasing higher than the previous targets?
Yeah, I'll just give you an overview that, as you rightly said, we had said maybe about 2.5 years back that 20 gigawatt by 2030 and 10 gigawatt by March 25. Without any inorganic opportunities, we are on track to reach this close to 10 gigawatt by March 25. And O2 platform by June 25 of 2.3 gigawatt. And also there is another process in which we have been IBC process for a thermal asset where we have got we have been declared the successful bidder. The process is on. Maybe LOI and the completion of the deal may take few months. So with that, by June 25, with both the O2 already done, if that also happens, and 10 gigawatt of greenfield capacity, so we will be, that portfolio of thermal is 1.8 gigawatt. So we will be definitely in excess of 13 to 14 gigawatt. This is the number we are seeing by June 25. So we are definitely far ahead of 10 gigawatt by March 25. So yes, now with the pipeline of another 9.2 gigawatt with from JSW Energy portfolio and O2 also over and above 2.3, another 2.4 gigawatt. So the pipeline takes us to 24-25 gigawatt, and there are signed PPAs which have a timeline of 18 to 24 months for completion beyond 10 gigawatt. So definitely we will be accelerating our growth, and now we will be sitting on the desk and drawing board to work on our strategy 3.0 for FY30, and maybe soon we will be coming out with our numbers. We are working on that, definitely.
Got it, Mr. Mahinder. You know, the acquisition value is also for a large sum, largely around 12,460 crores. How will the company be funding this? Could we see an uptick in the debt rising from current levels as well?
See, just to give you an idea that still the deal is to be consumed in 5 months timeline, which is there from the signing of the SPA, but we are quite confident that it will happen earlier. So numbers are going to be dynamic. Specific for 12,468 crore, the value is that because the part of net working capital, which is a dynamic number, when we close, we will be ready with the exact numbers. But yes, we have to remember in terms of funding that what we have, you may recall that in April 24, we raised a QIP of 5,000 crore, successful raise of funds we did through that route. And in September closing, H1 closing, we have reported a free cash of 5,700 crores. So we are very, very comfortable with it will be a mix of internal accruals, plus if we, in case the debt is to be raised, but exact numbers will be coming. In terms of ratio, if you are asking debt to EBITDA ratios, what we have declared of 4.1 end of H1, and if we remove the construction work in progress, which will give us the returns once the capacity gets commissioned, it was a very comfortable number of 2.2. Even if we talk of net debt to EBITDA, including CWIP, the industry average is 5.5 to 6, wherein the rating agencies are comfortable. We were at 4.1 in September. So all these gives us a lot of cushion and headroom to accelerate our growth, and our strong balance sheet strongly supports that.
Well, that was another acquisition, but I also want to touch upon other points. There's also been news flow of the company entering the wind turbine blade manufacturing sector. Could you maybe give us a comment or insight on this development?
Yes. See, we have announced earlier that we signed the technology license agreement with Stanley, China. I'm happy to tell that the manufacturing facilities in India has started by Stanley, and the rollout for our own captive requirements from that facility by Stanley will start sometime maybe between January and February, maybe a month or two from now. So, and that is a 4 megawatt platform, which is very, very helpful in terms of the per unit cost of construction, and very helpful with the Indian conditions. So that is one. Another part where we are going into manufacturing is the wind turbine blade manufacturing. Blade is a huge cost if we have to import, because logistics plays a very, very high cost. So we are setting up our manufacturing plant under the technology license agreement has already been signed with SANY. So we are setting up our plant in maybe 9 to 12 months time. This blade plant manufacturing for our own captive requirement will start, which will significantly help us in reducing our cost of per megawatt construction cost.
You mentioned cost. How will it help cost from the wind energy side, and how much will the company be investing in this venture?
See, cost perspective is very dynamic because this is a location where internal movement of the blade also happens. So we are in the process of deciding whether one plant or two plants we put nearer to the geographies. Those are dynamic numbers we are working on. But definitely, it will be a significant reduction in the project cost.
I also want to talk about, JSW Energy's foray into energy storage, which has been significant, 16.2 gigawatts of locked-in capacity. What kind of revenues could one expect from this area? And also, could you give us, the update of the 1 gigawatt battery energy project in June, the 12 gigawatt pumped hydro project due in around 48 months? How will the capacity addition in energy storage take place for the company?
Yeah. See, I'll just come to first battery energy storage. The project is on track in terms of the construction, which is Asia's largest capacity at a single location of 1 gigawatt hour. We will be commissioning that in June. And part of the capacity is already tied up. Part is capacity as the project was designed is merchant, which will help us in evening peak hours when the demand is more, at times the supplies are a constraint. So we expect that to commission the full capacity by June 25. Work is on full swing. Apart from that, as you said, 12 gigawatt hour of pump storage. Yes, for that we have already signed the power purchase agreement, and now maybe in a month we expect the construction work on the site to start, because we have been working on the site for last more than a year to be ready. So it is a shovel-ready project now where we are starting. Over and above that, we have recently received the letter of award from UP also for a 9.6 gigawatt hour of pump storage project, on which also the site, our team has been working for more than a year. So that PPA we expect to be signed very soon. So the total locked-in capacity is 12 plus close to 10 gigawatt plus battery energy storage. So we are close to at about 22 to 23 gigawatt hour logged in capacity, as we have declared in our 2.5 years back that 40 gigawatt hour storage by FY30. So we are well on track on those lines.
Lastly, I want to get a sense of the financial performance. Now, the last 3 years, revenues, EBITDA and margins have shown growth, but profits have remained largely flat on a CAGR basis. So, Mr. Mahendra, what are your expectations in terms of growth in FY25 and FY26, as well as for margin expansion?
The thing is, once the capacity, we have to remember in last 2-3 years, the shift is happening that moving the thermal portfolio percentage in the overall portfolio has been reducing. So, which in fact, in a way is positive, insulates the business from the business dynamics, whether the fuel cost, the coal cost, other things. And this is whatever capacity additions we are now investing is with tied up long-term PPAs with the defined tariffs. So better will be if we see revenue flat, may not carry that meaning, because revenue, once the percentage of renewable energy is there increasing, the revenue, it may not be the right benchmark to compare, because if the coal-related thermal portfolio is reducing, that it will have an impact on the revenue, but more important will be the EBITDA margin and the PAT. We expect going forward with this range, this will definitely be significantly will be improving the EBITDA margins. We will see a large jump in the coming year is what I can say right now.
Lastly, Mr. Mahendra, could you maybe give us a sense on how much the company earns per revenue per megawatt when it comes to wind, solar?
See, we don't normally do that when we see the platform blended tariff. If we take because this is dynamic solar, which area, what is the CUF, what is the energy generation, what is the tariff. But if we take an example of O2 with a 4.7 gigawatt, and you can take a mix of solar and wind, and with the average CUF of maybe 29%, or 30% blended this thing, what is the energy generation, and the blended tariff of 3 rupees 37 paisa will give a significant idea of the revenue. But we have to keep in mind that the positive upsides which are there in the platform is that we at JSW have been doing our self O&M with a very, very highly qualified team. So, and then the O&M optimization overall, and the synergy is that 7 states where O2 platform is present. And out of that 5 states, already JSW Energy has a strong presence. So a lot of synergy will come in optimizing these costs and bringing the upsides in the EBITDA margin and the PAT.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
We set you up for the day's trade. 30 calls before the markets open on NDTV Profit.
Jubilant Food above a 600 level on Friday.
Wipro can be first trade to buy
all commodities, but in that Vedanta looks good.
Our experts give you the top stock ideas to prepare you for the day.
ICICI Lombard stocks hit the first target. It has given a very good momentum with good volume.
Don't miss the chance to make the right moves. Only on NDTV Profit, where winners are made before the bell rings.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Log Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Log Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Log Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in?
We're back with India Market Open right here on NDTV Profit. In minutes from now, of course, we'll have the new listings as well, and therefore that's something that you might want to watch out for. But I want to mark a few stocks. So firstly, Garuda Construction and Engineering, the stock started off absolutely flat. We spoke about it in the morning that Utpal Sheth has bought into it, and I think that is what now the street has realized. Trust Mutual Fund also, I think, bought into it, but Utpal Sheth's name attached to it, the stock has zoomed in trade. So 6.5-7% up for Garuda Constructions. Watch out for that one. Jacob and Reliance Industrial Infra. Now, this is a sentiment thing, but because there is a first commercial flight testing happening at the Navi Mumbai International Airport, companies which presumably have land bank around the Panvel region will probably benefit, and which is what, not Reliance Infra but Reliance Industrial Infra, RIIL and JCorp. Those are the two that have also perked up a little bit in trade. There is strength in Anu Pharma, 8% higher. There is strength in the medical, about 6.5-7% higher. Navkar Corp is now at 172 rupees, and if we can pull up the last 1 month chart of Navkar Corp, it's 6% higher right now. The last 1 month Navkar Corp is up about 15% in trade. Very strong show by this one too, so good going. Inox Green is up about 6% as well, so pretty strong showing for that one too. Now the new listings, and remember, as per the subscription numbers, Senores, Ventive and Carraro, and both Ventive and Senores have decent listing prices. We should try and pull up those stocks for you. Carraro is down about 7%, Ventive about 12% higher, Senores about 54% higher. No surprise here on the listing prices per se. The question only is, can any of these inch up? Speaking of which, we should try and see if Translate Lighting or Dam Capital, and what is the kind of moves that those are making today. These are stocks that listed in Friday's session, and wonder what the new listings are up to, or those listings are up to as well. So should get both Dam Capital and Translate Lighting as well. Dam is down about 5% in trade. The 1 month chart is in no point. Translate is about 2.5%. So interesting moves there on some of these stocks, the Agam. Well, okay, so that's the new kids on the block. Now, Vodafone Idea is the stock in focus as well, has welcomed the government's move to waive off bank guarantee requirements, admitting that the move will benefit the company. Mihika Johnson with more on this. Mihika.
Thank you, sir. So Vodafone Idea is buzzing. It's up around 3%, and this is after the Department of Telecommunications waived off the bank guarantee requirements for telecom operators. Now, these bank guarantee requirements were required for spectrum auctions before the 2021 reform package. So that the bank guarantees have been waived off for 2012, 2014, 15, 16, and 2021 spectrum auctions. When you talk about how this benefits Vodafone Idea, well, it makes their liquidity for capex higher. So they had around 24,800 crores obligated to be provided for the bank guarantees for the spectrum. So now the waiver will ease the financial burden on the telecom operator. It also highlights the government support to the telecom industry and network expansion, and will allow telecom operators, this 24,800 crores could be used to invest in more 4G, 5G network rollout across India. But it's key to note that not all is waived off. There's a one-time partial bank guarantee for the 2015 auction that still remains. However, the company has stated in its press note that discussions are ongoing to finalize the final amount of the partial bank guarantee shortfall.
Okay, Mika, thanks for that. So that's as far as Vodafone Idea goes. Now, as 2024 comes to a close, Indian economy has seen its share of highs and lows. From inflation and interest rate battles to signs of recovery and growth, the year has been eventful for markets, industries and consumers alike. It's a comprehensive look at how the economy shaped up this year and what lies ahead.
How was year 2024? Well, for the Indian economy, the year might have started off on a solid note, but it did end on a little bit of a sour note. GDP growth in the January-March quarter of 2024 had come in at 7.8% and eventually fell to a 7-quarter low of 5.4% by the July-September quarter. Now, alongside slower growth in industrial GVA, which was led by manufacturing, we also saw slowing in private consumption and capex from the previous quarter. Now, looking ahead, robust Kharif food grain production, good Rabi prospects, the festive and the wedding season, and a pickup in government capex are all expected to provide some support to economic growth. Still, the RBI did end up having to revise real GDP growth forecast for FY25 to 6.6% from 7.2% it had previously projected. Now, coming to retail inflation, well, food prices continue to remain an Achilles heel for India. In October, in fact, headline inflation rose to the highest print we saw in 2024, above the RBI's tolerance band. It came in at 6.2%, and the consumer food price index had showed double-digit growth of 10.9%. We did see a step down in the next print, but going forward also, food inflation is expected to soften in Q4 FY25 with seasonal easing of vegetable prices, Kharif harvest arrivals, alongside expectations of strong Rabi production. Still, adverse weather events and a rise in international agricultural commodity prices continue to pose upside risks and will have to be closely watched out for. Now, owing to these inflation trends, the benchmark lending rate or the repo rate was on status quo by the Monetary Policy Committee at 6.5%, and this has been followed by growing calls of a rate cut which we may see in 2025. 2024 saw a resurgent dollar and the rupee continuing to breach fresh record lows. Active central bank intervention did ensure low volatility compared to other emerging market currencies, but the rupee is set to see a more volatile 2025. Now, that's because of Donald Trump assuming office and is expected to employ tariff as well as non-tariff barriers to promote US manufacturing and services. One front India did derive comfort on was Brent crude prices having fallen by almost $10 a barrel compared to where we started the year off at. For the next year as well, oil prices may face further downward pressure given the demand-supply dynamics. All in all, it's been a mixed bag for India's economy, and we're still going to be watching out for how the fiscal year ends, be it in terms of where GDP growth settles at or the government's fiscal deficit target. For more on that, stay tuned to NDTV Profit.
With 2025 just around the corner, Jefferies has come up with Greed and Fear report that provides outlook on key sectors. Here's Anushi standing by to give us an update on that one.
Hey, thanks for that, Agam. So in Jefferies, in their Greed and Fear note, they've emphasized on certain changes that one should be looking out for. This pertains to both their Asia ex-Japan strategy and also the India long strategy. So for Asia ex-Japan long only portfolio, HDFC Bank has been reintroduced again with a 4% of weightage. This 4% weightage investment for that would be led by cuts in some of the other names, that is Macrotech Developers, L&T, ICICI Bank, Axis Bank. This is by 1% each. So this 4% cut in these four names would make up for the 4% reintroduction that they planned for HDFC Bank. Siemens Limited is another stock that they've added with a 4% of weight. This is by removing Samsung Electronics and cutting down their weight in SK Hynix by 1%. Coming to the India long only portfolio, Cements again added with a 4% of weight here. This they've removed by investment in their AU Small Finance Bank and added 1% weight back in HDFC Bank. This is aided by the cut in Axis Bank weight by around 1%. So this is the overall strategy that Jefferies has pointed out for its Asia ex Japan long-only portfolio and India long-only portfolio.
Right, Anushi, stay with us. Tell us also what Morgan Stanley has made of Zinca Logistics. I believe the stock has doubled from its listing very recently, but they are underweight.
Right, so Morgan Stanley has initiated a underweight rating, and this is at the target price of 450, which is a 16% downside from the previous trading session's prices. This is after the share price, what it has done post its November 24 listing. It's been up around 105%. So already a strong rally that we've seen in terms of performance. So considering the rally that has happened, they now find the risk to reward ratio unattractive for the company. Other factors which support their underweight thesis include high market share in the core tolling business, but now they see limited opportunity in terms of where the total addressable market is, and thus the limited upside to growth assumptions from these levels. External risk factors also include around their merchant discount rate. So this points to a unclear visibility in terms of medium-term growth and margin projections for the company. Optionality from new services is still in the early monetization phases, so this is yet to be proven as how this would benefit the company going forward. If you do note, Zinca Logistics has built a niche and competitive moats in a large fragmented market, and if their core business, the revenue potential is very strong, around 24% of CAGR that they expect over FY 25 to 27. But considering the kind of price rally that has happened, along with the limited growth upsides now that Morgan Stanley sees, they have this underweight rating, and a 16% downside is what they expect.
Okay. Well, but the stock is down about 4% in trade today for sure. Thanks a lot for that, Anushi. What is up today is JSW Energy. You heard the management, of course, but for people who are tuning in right now to the channel, here's why JSW Energy is up 5% today. They made an acquisition. Now, O2 Energy. Now, why this is important? Because Motilal Oswal says that, according to them, of course, their math, and their target price is some 810 rupees. No, this is fine. This is what JSW Energy's largest acquisition since inception is fine. There is a Motilal Oswal note, which we've spoken about in the morning, which I want to highlight. Their target price is 810 rupees, and Motilal Oswal says that the deal adds an optionality of 57 odd rupees to JSW's total value. Now, why do they say that? They say that this is because the interest cost, right here. This is what I was referring to. Let's move on from this on to the other lines as well. So Motilal Oswal says that the interest cost for O2 is 43 days, lower than JSW, 8.8% at par with JSW, and the receivable days at 43 days is lower than JSW's receivable days at 68 days. They also go on to say that the whole transaction includes the portfolio of O2 Energy, which is 87% of the portfolio backed by utilities such as SECI, NTPC and SJVN, all of which are blue chip. And the 30% of the CNI portfolio is largely comprising A companies, AA rated companies or higher. So I think the derivation is that the chances of bad assets or NPAs remain much lower, and hence I think the stock has reacted the way it has. 4.5% off the highs of the day, but still in the green.
Right. Let's also put the spotlight on EPA Laboratories. Let's pull up the stock firstly and see what it's doing. Well, it is marginally in the green right now, up by around 0.6%. But the reason why we wanted to bring this up is because we have a Motilal Oswal note, and they remain positive on this. In fact, they've given it a buy rating, and they see an upside of around 21%. We have Varsha back with us to tell us about what this note entails. Varsha, over to you.
Well, yes, Agam. So, Motilal has maintained buy on EPA Labs with target price of 1,980, implying potential upside of 21%. Let's see the reasons for the same. So, they are anticipating 27% earnings CAGR from FY 25 to 27 with 170 basis point margin improvement. And as EPA is relaunching approved products with stable pricing and filing 15 to 17 new products over the next 2 years, according to Motilal Oswal. Company also plan to file 15 to 17 new products in US over the next 2 years, which is the next leg of growth. One of the reasons why Motilal has maintained buy is the Unichem integration, which will boost margins for the company. EBITDA already improved to 12.4% in Q2 FY25. Company will leverage Unichem's portfolio in Australia, New Zealand, Europe and rest of the world markets. Company is also launching new divisions in dermatology and orthopedics. This is also one of the reasons why we are seeing this 21% upside potential by Motilal Oswal. Lastly, if you see, brokerage is actually anticipated 23% CAGR in exports from FY24 to 27, driven by product filings and EU market expansion, and also companies developing niche pipeline of 8 biosimilars in oncology, ophthalmology and anti-inflationary therapies.
Okay, well, so EPA Labs is one more that you want to keep in mind as well, as per the brokerage note here. Remember, the other thing is while you look at individual pockets and keep a bottom-up portfolio as the key, what is the top-down strategy? What is the broad strategy in a scenario like this? And from somebody who is perched abroad but looks at India as well as the rest of the world. And I think that's the perfect guest to have today. We have Vikas Prasad, Portfolio Manager at MNG Investments, joining us, I presume, all the way from Singapore. Vikas, is that where you are at currently?
Hi, good morning. Yes, concluding the year at home. I'm here.
Okay, fair call. Vikas, good having you. Thanks so much for joining in. Neeraj here. Let's start by thinking of how are you looking at 2025 as a year? Is it a year that belongs to a certain set of markets like the US, or could it belong to the emerging markets? And then we'll move on to what within that landscape may or may not look attractive.
It's hard year to year to see or to think which year will belong to which markets. However, what we've seen for 2 decades now is that India and the US have led equity returns around the world. I think on a prospective 3, 4, 5-year view, that should remain the case. Now in the US in particular, we've seen a material re-rating and we've seen a very narrow rally. What's healthier about India is that heading into the end of the year, we've seen a bit of a de-rating. And part of that was justified. The September quarter earnings were not as good as expectations. But when we look forward, it's normal to reflect. Every year for the past few years, I've gone through the same exercise. Is this the year the Nifty streak ends? Is this the year India disappoints on equity returns? In September, I thought the probability was higher that would happen, but the case for Indian equities still looks good in a regional context, in an emerging market context. Also, our view remains that as an equity market, India no longer is an emerging market. We think it has emerged. How much more does it need to emerge? $5 trillion market cap, massive economy, rapidly growing, busiest IPO market in the world. And so I think that from here, the case for Indian equities remains pretty constructive, and we are positioned accordingly. We are fully deployed in India. We've been active on the ECM front, but we have a lot of core holdings as well that continue to perform well.
Because what are you making of Trump 2.0? What does it mean for American markets? And what sort of an implication can it have for Indian markets? So because from what we understand is that there could be some inflation based on, in anticipation of the policies that he has in store. We've already started seeing yields harden, the US 10-year yield specifically. What does it mean for the US markets? And do you think that there could be some fund flows coming back to India based on that?
So this is an interesting question, and let's look at it in parallel with the China and US dynamic and what that implies for Chinese equities also. That's another market where we are constructive. That's another market where we have allocated more capital this year. The difference is in 2016, when Trump 1.0 kicked off, Chinese companies were not really ready for what came. They are now much smaller, leaner, better allocators of capital. And the relationship between Xi Jinping and Trump might evolve. Xi Jinping was invited to Trump's inauguration. Now, conversely, you look at India, and Trump 1.0 was better than Trump 2.0 might be. That's what we're prepared for. We are widening out our earnings scenarios. We're widening out the tariff and revenue growth scenarios for companies that are particularly exposed to the new policies that will come out of the White House. So we might see a difference. Chinese companies might be better prepared this time around. Indian companies might have some surprises in store for them. Now, India broadly is is very important to the US. And so that will be taken into consideration as the new administration crafts policies. But you're right, this is the right thing to be focused on. And I suspect that there will be some surprises along the way. In 2025, we've already seen that. If you look at the automotive parts companies that have facilities in Mexico, as an example, we've seen some volatility in those share prices. We've seen some deratings in those share prices. That probably continues at least for the first half of the year.
Okay, because the other aspect is that there are large sectors in India which haven't quite done as well as their fundamental performance has been, particularly banks, for example, right? Because there's this incessant FI selling that has been continuous in Indian markets for the last 6-7 months. So there is a technical element to it as well. And you can sense it because fundamentally the performance hasn't been that bad, if you will, or has been reasonably okay in certain cases. Could we see that selling ebb at some point of time if indeed there is no rate hike trajectory in the US, or if rates stay constant, if you will, and if the dollar strength were to just kind of cool off a little bit, if you will? And can that help fundamentals meet valuations in case of banks? A lot of banks, private sector banks, available 1.5 times FY26, FY27 book valuations as the case may be. Is this attractive enough, or would you rather fish in different ponds?
Well, there's a few things to unpack here. First, I agree with you that if you look at financials, which is a very broad universe, as you know, if we focus on private sector banks, we feel that there are opportunities there. That's the one part of that broader financials area that we are overweight. If you look at this year and the names that have underperformed materially, hydrocarbons, those companies, especially in the second half of the year, the consumer staples companies throughout the year, but especially post-elections, that initial bump that we saw when people were assuming that there might be some more socialist policies. In Q4, we've seen that as the tide has gone out post-earnings, these companies have not been prepared for that. Now, when you come to the banks, this is such a large, diverse universe. We remain zero-weight or materially underweight the microfinance institutions, many of the consumer finance names. We're beginning to see some stresses there that weren't there at the beginning of the year. Now, microfinance has been dealing with issues all year long. Then you layer on top of that the regulatory pressures, and we feel that you have to be even more selective than you are in other spaces. A, because there's so many more choices, but B, because the earnings outlook varies a great deal from bank to bank, from sector to sector within financials. But private sector banks here, I agree there's an opportunity. If you remember what happened to the largest private sector bank in Q1, material underperformance, but look at it since then. And people who kept the faith there in the management team, in the broader outlook, and just looked at the valuation, realized that there was a disconnect here. It has changed in this 40% or so rally from the lows, but its peers continue to be positioned well, we think.
Vikas, tell us about emerging ideas that you guys are spotting or you guys are doing work around for now when it comes to India.
Well, so we start with cooling. If you look at the air conditioning names, this is a sector where we increased our positioning materially in the first half of the year. And as we head into the end of the year and we look at next year and you look at names that have outperformed, it's natural to think that maybe this is the time to take profits. But if you look on our time horizon, 3, 5, 7 years out and beyond, India cannot achieve the economic goals that it has. The people cannot achieve the productivity levels that they need without massive deployment and penetration of industrial and home-based cooling. So the air conditioners are a natural place to start. But then if you look at the derivatives of that, the companies that are manufacturing these, the outsourced manufacturers, there are opportunities there. Now, those companies have re-rated even more than the air conditioner OEMs. But we continue to like that. We continue to be overweight that space, even here, despite the performance. Again, this is a very long-term theme. If you're looking for long-term investments, you will find them here. So that's one. Before I get to the rest, I'll also say, what have we not changed about what we don't like? Consumer staples, I mentioned earlier. We own fewer consumer staples names today, heading into 2025, than we ever have. And most of those are zero weights. They're not even underweights. And so we have a very selective exposure to that sector. I don't see that changing anytime. If you broaden out the consumer exposure, paints, yes, they've underperformed, but the earnings cuts have been material. And for the first time, we've seen material deratings rather than a re-rating, or at least holding the multiple, because what the market is implying, or what the current share prices are implying, is that there's more pain to come. Now, to come back to what we do like, the auto derivatives, auto parts, that still seems interesting. Hospital, life sciences, healthcare broadly defined, we still like that. Pharma has done very, very well for 2 consecutive years. Hospitals have done very well for 2 consecutive years. Again, doing your homework, being selective, still yields opportunities there. I'll mention one last thing, which is exposure to the luxury spending theme. When I moved to Asia 20 years ago, in 2005, everything was all about the bottom of the pyramid. Harvard was writing case studies about small little sachets and the penetration and distribution. We've seen that narrative invert, and we still see a lot of opportunities heading into the end of the year and into 2025 at the very top of the pyramid. And that's where our portfolio is allocated as well. I'm happy to go into some more detail, or we can talk about other sectors as well.
Some detail is welcome, Vikas, there. And then we'll talk about the other sectors too. Just trying to couple in this point that when you are looking at taking positions now in this market, are you elongating the time frames for the returns? Because hitherto the market was buying, and people met their internal targets way earlier because of the gush of liquidity. Do people need to reallocate or rethink their timelines?
Yes. Okay. So this is a great question. But when we invest in a company, the intention is that our holding period will be in perpetuity, that it will be indefinite. However, when we evaluate our portfolios, we realize and we recognize that we buy our portfolios every day. We are underwriting our portfolio every day. So we are focused on prospective returns each morning when the market opens, each day when it closes. And that calls for some reallocation of capital when companies have done as well as they have. When you've seen the inflow of new opportunities to the extent that we have. 5 years ago, I was just looking at this over the weekend. In 2020, we had maybe 30, 40 IPOs. This year, we've had over 300. I would be surprised if we materially exceed that number next year. But if you look at the investable universe in India, it has now grown to 6,000 companies. There are about 1,600 companies with a market cap over $100 million now. So when you have so many new opportunities and you have material outperformance of India relative to other markets, and then within that, the leaders, the breadth that we've seen and the material outperformance of leaders in their sectors, then yes, it calls for a reallocation of capital. I mentioned a couple of themes earlier that we are not taking profits from. In fact, we've added in Q4, cooling being one of them. But yes, we don't hold with a particular time horizon. It's just indefinite. But because we're focused on prospective returns in this market, we probably have traded a little bit more this year, or last 18 months, I would say, than we have in previous years.
Okay. Because did I hear you, just last question from mine, did I hear you say hospitality? And I'm just wondering, when the new listing today, ITC hotels business getting demerged, a lot of builders thinking of a hospitality portfolio of their own, Prestige, Oberoi, etc., and the listed players talking about very strong growth. Is this a sector that is good to keep in the portfolio?
Yes, I had mentioned hospitals, but I'm glad you mentioned hospitality because that is in our portfolio also. There are some benchmark names that we hold. There is some off-benchmark exposure as well. And this is yet another space like hospitals, actually, where you've seen a lot more choice on offer in the past 2-3 years through the public market listings that we've seen compared to years before. Yes, this is also part of the Lux theme that I mentioned. I talked about there's the obvious area to talk about, which is high-end real estate. But hospitals are a part of that. Hospitality is a part of that. Airlines are a part of that. There are many ways to express this view that wealth is becoming more concentrated. And what the implications are for society, that's a different and longer conversation. But when it comes to investing opportunities, we continue to think that this is not a fad. This K-shaped recovery that we saw coming out of COVID has become indeed a K-shaped economy. And we continue to see opportunities there, and hospitality is a key part of that.
Vikas, we'll leave it at that. Thank you so much for joining us and giving us your perspective on Indian markets, how things could potentially pan out in all the stocks that you are looking towards and interested in, and of course those that you look less favorably towards. Well, on that note, it's a wrap on this edition of India Markets open. Up next is Ask Profit. Don't go anywhere. Back in just a bit. Stay tuned in. Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
We set you up for the day's trade. 30 calls before the markets open on NDTV Profit.
Jubilant Food above a 600 level on Friday.
Wipro can be first trade to buy all commodities, but in that Vedanta looks good.
Our experts give you the top stock ideas to prepare you for the day.
ICICI Lombard stocks hit the first target. It has given a very good momentum with good volume.
Don't miss the chance to make the right moves. Only on NDTV Profit, where winners are made before the bell rings.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit.
Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit. My name is Alex Matthew. We'll take you through the next 1 hour of trade. Now, of course, this show is geared towards getting you answers to all of your stock-related questions, and to that end, we've got two options available for you. You can either call us on the number that will soon be on your screen, or you can WhatsApp us on the number that you just saw. Let's take you through how the markets are doing towards the end of this year, and it's very range bound at this juncture. Taking cues from overseas, you had, of course, a poor close, if you can call it that, in the US over the course of Friday, and it was thin trading that you saw there. That seems to be the case in the Indian equity markets as well. We have hovered in a range, all negative at this juncture, but then we're inching towards Friday's close as we speak right now on the benchmark Nifty 50, 23,800 on the ticker right now. Mid-cap index up about 0.2% as we speak, and the small cap index down about 0.2% or thereabouts. So very tight, very narrow ranges, and I won't be surprised to see the volume picture
Similar to what you have seen in certain international markets, we are, of course, in the last couple of trading sessions of the year, and a lot of people on holiday. Perhaps you're watching from home as well. Let's take a look at a few stocks then. And actually, before we do that, let's take a look at the sectoral picture just to give you a sense of what is buzzing in trade today. Not too much to speak of. Of course, just about halfway or thereabouts in terms of the winners and the losers. But what stands out? You have right on top of the screen, you have the healthcare index that's doing reasonably well. You have pharma that's up and about in trade today. Among the losers, you have auto, which is down about 0.75% or so. And you have the IT index, which is losing about 0.25% or thereabouts. Quickly take a look at the contribution on the Nifty 50 just to give you a sense of what's moving the needle in trade today. And you have the likes of ICICI Bank, Adani Enterprises. Couple of interesting notes, by the way, on Adani Enterprises talking about a significant upside. You have Sun Pharma, which is up and about, and you have Axis Bank. Adani Ports also gaining ground. Among the losers, you have Infosys from the IT pack that is losing down. And you have Trent, Mahindra & Mahindra, Bajaj Auto, Maruti Suzuki. So more or less reflecting the sectoral picture that we just displayed to you, and that is reflective in the contributors of the Nifty 50 as well. New listings today, why don't we pull all three of them up? Carraro India is one, Synoris Pharma is the other, and you also have Ventive. Ventive and Synoris doing particularly well. We will soon have the management of Carraro India, which is not having the best listing. We're joined at the start by Saurabh Jain as well as Ajit Mishra. Gentlemen, thanks so much for taking the time, and as always, compliments of the season heading into the last couple of days. Very quickly, I'll come to you first, Ajit, just to give us a sense of how the markets are as you're looking at it on the charts. Volumes not too much to speak of.
Yeah, good morning, Alex, and season's greetings to you and all the viewers. So yes, the last week was a week of consolidation, wherein we saw that index continue to defend the long-term averages, 200 days of exponential moving average. And today also we are seeing a similar kind of a day, wherein after the initial downtick, we are seeing some rebound from that area. So in a way, it's time-wise, correction after this sharp decline, and 23,700 LX is the make or break area for the Nifty. So if we fail to hold this area, definitely we expect Nifty might make an attempt to retest the November month low close to around 23, 250, 260 zone. So as of now, bears are still under control comparatively, considering that the recent attempt of recovery towards 23,870 and 24,000 zone, we saw that the selling pressure emerged on every uptick. So positionally, the tone is negative. Intraday or for a day or two, it's sideways.
Okay, all right. So that's the perspective of the benchmark. I told you we'd get you the management of Carraro India. In fact, let's listen in to some of what they had to say. It's a muted debut for them on Dalal Street.
This is an offer for sale, and it's a very, very big milestone that Carraro India has reached in the last 3 decades. OFS is mainly because the promoters from Italy have invested a big amount in India in the last 25 years, and it's natural that they would expect some return from their investments in India. They've been very patient. They've had the perseverance to believe in the Indian story, and we are very happy that we have been growing together with the Indian economy. And the future for us looks very bright because we are in the sweet spot of agriculture and construction equipment vehicles in India. We are providing the technology that is required for the farm mechanization and better vehicle equipments for the construction industry in terms of safety, in terms of efficiency. This is what India needs. We need farm mechanization, farm efficiency for our food security. We need better vehicles which are scientifically designed to meet our construction equipment industry. And these two are booming in India. And we are very happy that we are in the sweet spot supporting the Indian industry with the technology that is required.
All right. So that gives you a little bit of perspective on what the company does. Incidentally, if you've got questions about that, if you bought into the IPO and you're seeing a bit of a loss on the screen, then if you want to know what to do, then you can call us or you can message us. We've got our first caller of the day. We've got Raj calling in from Hyderabad. Good morning, Raj. I certainly have heard your name. And how can we help you today?
Good morning, Alex. Wish you advance Happy New Year.
Thank you so much. Wish you the same.
Yeah. So I have Engineers India share.
Okay, Engineers India.
I bought it 221.
Okay.
And now I'm in loss only. So I just want to know whether I can hold or exit.
Yeah. So it's come off the 52-week high. Certainly, that was close to 290 levels. When did you buy this, Raj? Can you tell us?
6 months ago.
6 months ago, yeah. So it's not too, and it dropped pretty quickly after that. I think you must have been trying to catch the bottom. Was that the attempt that you had?
Yeah. So actually, I'm very much interested in this because they are into different domains. Consulting, they are into designing, they are into procurement.
So when you bought for the long term, Raj?
Yeah, I bought it for 1 year origin.
1 year or more, right?
Yeah, 1 year or more, correct.
Okay, so let me go across for the first time today to Saurabh, just to give you some perspective on Engineers India. 900 shares bought at levels of 221, slightly elevated considering that the share price has dropped quite precipitously from that point. What do you make of the company? Would you hold on, Saurabh?
Hi, good morning, Alex. Thank you for having me on the show. See, the company primarily gives services to the oil and gas sector. Now, what is happening in the sector with the price, oil prices dipping, and the outlook is that the demand for the oil will cool off. That is why we are seeing pressure in the oil prices. Now, what happens when the oil is in the pressure, oil prices are in the pressure, the activity usually cools down. For the company, it's like Engineers India, and that is why we are seeing pressure in the stock. And if you look at the numbers, the September quarter's number, there is a quite decent amount of pressure on both the revenue and the profitability front. The profits dropped from 100 crore to 76 crore, and there is a drop in the revenue of about 100 crores. So I expect this pressure to continue. I don't expect any kind of upside in the business or in the stock price. So my advice would be better to exit from the stock.
Better to exit is the view, Raj. Hopefully that helps you. Let's take the next question, and we've got one on a recent listing, International Gemological Institute of India, which has had a pretty decent run since listing. It's up about 19% from that point, or close to 20%. We've got a viewer who has not told us his name, who's okay, so Ajayan, who's bought 1,000 shares, and I do not know the buy price, but he's wondering whether to hold or exit at this point. Saurabh, any view on this? IGI, I found interestingly that it also looks at certification of lab grown, or it has a portion of its business that's oriented towards lab grown diamonds, which I think is all the rage right now.
Right, Alex. The company do not only do certification for the natural diamonds, but also on the lab-grown diamond side. Now, the case is there is a kind of a 10-12% growth in the CAGR growth in the natural diamonds, and there is a significant amount of growth which is coming into the lab-grown diamonds space. While this space is small, but I think there is very much for the company to go in terms of business. So for the long term, I feel that it is a good company to hold on. This is the only one of its kind company which is listed on the bourses. So my sense is for the long term, it's a hold.
All right. So we've got the next question on SMS Pharma. I'm just trying to pull up the chart, and this is a question, in fact, from. All right. Let me just try and pull this up. Okay, we've got Bharat who's asked this question. Okay, sorry, say that again. Sarat. All right. Yeah, so in case you were wondering, that was me trying to get my team to tell the viewer's name. When you're sending us a message, please tell us your name, because it becomes easier for me to take those questions. And SMS Pharma, 400 shares bought at 208 rupees per share. The 6-month view is being sought. Ajit, on the charts, how does it look?
So Alex, in fact, if you see that in the recent market correction, pharma and defensive, they are doing pretty well, the healthcare space. But SMS, on the other hand, is still struggling below its major averages. So indications are in the favor that we might see some rebound or recovery due to the oversold position. But comparatively, it's a weaker structure, and since he has bought it at the lower end, means close to around 208, and he's still in the profits, I would recommend him to switch the position to Glenmark, Sun Pharma, or Lupin from SMS.
All right, so that's the perspective on SMS Pharma. We've got Preetham from Bengaluru who's asking about Hyundai Motor, bought 90 shares at a price of 1,813. And this is a stock that has not done incredibly well since listing. It is trading below the buy price at this juncture and below 1,800 for that matter, up about 1/3% in trade today. It's down about 8.3 as you can see from the listing day. Saurabh, on the fundamentals, would you hold on to this?
Fundamentally, if you look at the automobile sector earlier, there was expectation that the car sales will grow in the high single digit. But after the first half and the recent numbers, it is quite evident that the growth will be sub 5% only. So that is for the whole industry, and that is why we are seeing pressure coming in the Hyundai India also. Hyundai Motors. The SUV segment is growing, but yes, there is a good amount of pressure on the other cars, the other segments. So, in my sense, I think it is better to take money off the table. It is. I think one should wait while things get settled down. After the COVID, we saw a good amount of double-digit growth coming in the automobiles companies growth. But now I think it is actually tapering off. So my sense is better to get out.
All right, we've got several questions on the fundamentals. I'm going to try and take a question on the technicals as well. And we've got a couple of questions, in fact, one from Karthik, another from Nick about Reliance Industries. Karthik is holding 20 shares at an average price of 1,426. Should he add more at the current juncture? It's not trading too far, Ajit, from the 52-week low, which is around that 1,200 mark. It's trading at just above at 1,219 or thereabouts. Would you buy more at this juncture or wait?
So Alex, first a disclosure that we have recommended to our clients to invest in Reliance Industries of late, and we are eyeing a new high in next 12 to 14 months. And yes, the stock looks extremely oversold from the short-term trading perspective also. We have multiple supports around this 1150, 1170 zone. So we expect maybe time-wise, we may see further correction for a week or two, but eventually we expect the stock to recover strongly. 1270, 1320 is going to be the first area of hurdle, and then 1440 and the new high. So it's going to be a gradual journey, but yes, you can add if your time horizon is over a year.
Okay, add if your time horizon is over a year on Reliance Industries, one of the underperformers on the benchmark Nifty 50 this year, has had quite a torrid time since August of this year, in fact. We've got A. Mohan calling us from Telangana. Morning, Mohan. How can we help you today?
Thank you. Oh, very nice, very nice. How are you, sir?
Very well, sir. How are you?
Okay, very nice, sir. Doing well.
Okay, how can we help you today?
Sir, I am having one query that I possessed 200 Vedanta shares.
Okay.
So now it is going to